This is Africa, the most misunderstood economic story in the world. In 2025, Africa's economy grew by about 4.3%, similar to Southeast Asia, and faster than the global average. 12 of the 20 fastest growing economies in the world were located on the African continent. For decades, Africa has been portrayed as the fragile edge of the global economy, a region defined by political instability, debt crises, and dependence on foreign aid. And honestly, many of those challenges are still very real. The four largest donors have cut their aid spending in Africa. The United States has imposed some of its highest tariffs on several African countries. China, the continent's largest bilateral lender for much of the 21st century, now receives more from Africa in debt repayments than it extends in new loans. And on top of all that, conflicts in the Middle East threaten to push up the cost of fuel and fertilizer. Despite all this, many African economies are expanding faster than much of the developed world. The IMF expects that in 2026, economic growth in Africa could even surpass Asia, something that has historically been rare. The continent that was once seen as the world's economic periphery is quietly becoming one of its most important frontiers. To be sure, there is not one Africa. Some of the continent is at war or unstable, such as Sudan and Sahel, but the most economically important regions are far more stable. Internal conflict can even coexist with thriving industries within the same country. Nigeria, for example, has built fast-growing sectors in energy and fintech despite ongoing security challenges. And although foreign aid remains vital for the poorest countries, for Africa's larger economies, it has become little more than a rounding error. Until recently, investor optimism was growing rapidly. In the first 2 months of 2026, the value of bonds issued by African governments was higher than during any comparable period since 2013. African sovereign bond ratings have reached a 5-year high, and several stock markets across the continent hit record levels last year. So what exactly is driving Africa's economic resilience? And more importantly, could Africa become one of the major engines of global growth in the 21st century? For much of the past century, most African economies were built around a very simple model, exporting raw materials, like oil from Nigeria and Angola, copper from Zambia, cobalt from the Democratic Republic of Congo, cocoa from Ghana and Côte d'Ivoire. These commodities generated enormous value on global markets, but most of that value was captured elsewhere. The raw resources were extracted in Africa, shipped abroad, and processed into higher value products in Europe, North America, or Asia. The finished goods were then sold back to African consumers at far higher prices. Economists often refer to this as a resource-dependent economic structure, one that leaves countries heavily exposed to global commodity cycles. This boom and bust cycle has shaped the economic trajectory of many African countries for decades. The problem is that commodity exports rarely generate the kind of diversified industrial base that supports long-term development, and governments become dependent on volatile export revenues. At the same time, many African states inherited fragile institutions and arbitrary borders from the colonial era, which often made political stability difficult to maintain. The result was an economic narrative that became deeply entrenched in the global imagination. Africa was rich in resources, but poor in development, and for a long time that description was not entirely wrong. But over the past decade, something important has started to change. After decades of economic stagnation, many African governments began implementing a series of difficult and often unpopular reforms in the early 2000s. Fuel subsidies were reduced, exchange rates were liberalized, public finances were tightened. This restores macroeconomic stability and attracts investment. In some of the continent's largest economies, these reforms were dramatic. Nigeria, for example, dismantled its long-standing fuel subsidy and liberalized its currency markets. Painful measures that initially triggered inflation and public protests, but ultimately helped stabilize government finances and restore investor confidence. Egypt followed a similar path under an IMF-supported reform program, allowing its currency to float and tightening monetary policy to control inflation. Ghana has also emerged as one of Africa's most prominent reform cases. Between 2024 and 2026, it is expected to deliver one of the largest improvements in fiscal balances on the continent. Revenue mobilization and tighter control of government spending helped drive a sharp disinflationary cycle, bringing inflation down from more than 50% in 2022 to roughly 9% by the end of 2025. These policies were far from painless, but over time they helped lay the foundations for more stable economic growth. East Africa has emerged as one of the fastest-growing regions in the world. Over the past decade, Ethiopia grew at an extraordinary 9.8%, Rwanda at 7.5%, and Tanzania at 6.4%. One example of this transformation can be found in northwestern Tanzania, just 7 kilometers far from Burundi border, Kabanga, one of the world's largest untapped deposits of nickel, a metal that has become increasingly important for electric vehicle batteries. Geologists first identified the site's potential more than 50 years ago, yet for decades it remained undeveloped. Only now is Kabanga moving closer to becoming a major mining project under the majority ownership of Lifezone Metals, an American-listed firm. Part of the reason is the growing global race for critical minerals. The project has attracted attention from the United States government, which is increasingly interested in securing supply chains for metals used in batteries and renewable energy. But the renewed interest in Kabanga also reflects something more fundamental: improvements in Africa's economic and physical infrastructure. New grid connections have been built to supply electricity to the site. Roads linking the region to major ports have been upgraded, and a new railway line is under construction to transport minerals more efficiently. Many of these projects have been financed in part by African development banks and regional financial institutions, mobilizing capital from within the continent itself. Kabanga is just one project in Tanzania, which is itself only one of Africa's 54 countries, but it illustrates two broader shifts that could have profound consequences. First, foreign investors are beginning to look more closely at Africa, attracted by its natural resources, improving economic outlook, and favorable demographic trends. Second, and perhaps more importantly, Africans themselves are increasingly investing in Africa. This shift is personified by Aliko Dangote, the continent's richest man, who opened a $20 billion oil refinery in Nigeria in 2023 and is now exploring further industrial investments across the continent. In recent years, the continent receives less in aid than it does in remittances and foreign direct investment. FDI into Africa reached around $97 billion in 2024. Across cities such as Lagos, Nairobi, Cape Town, and Cairo, a new generation of startups has emerged, focused on digital payments, logistics platforms, health technology, and e-commerce. Together, African startups raised about $4.1 billion in equity and debt financing in 2025, marking one of the strongest years for the continent's technology ecosystem. Fintech remains the dominant sector, capturing roughly 32% of all equity funding. In countries where large parts of the population remain outside the traditional banking system, mobile payments and digital financial services are allowing millions of people to access credit, savings, and insurance for the first time. But for many foreign investors, Africa's biggest attraction remains its natural resources. The continent holds roughly 30% of the world's critical minerals. These resources are increasingly essential for the technologies shaping the global economy: electric vehicles, renewable energy systems, battery storage, and advanced electronics. America's trying to loosen China's stranglehold on several of these minerals, and part of the solution may lie in Africa. The estimated value of undeveloped mineral assets on the continent is about $8.6 trillion, roughly 3 times Africa's annual GDP. In the Democratic Republic of Congo, a fund backed by the American and Abu Dhabi governments is bidding for 40% of Glencore's stakes in 2 mining operations. The country alone produces roughly 3/4 of the world's cobalt, a key component in many lithium-ion batteries. For Europe, Africa offers opportunities to diversify its energy supplies. Total Energies, a French energy giant, has resumed construction of a $20 billion LNG project in northern Mozambique, while Eni, an Italian firm, recently announced 2 new oil and gas discoveries on the continent, where Qatar's sovereign wealth fund has taken a $500 million stake in Ivanhoe Mines, a Canadian firm advancing major mining projects in southern Africa. Japan and India have also agreed to cooperate on investments in African minerals. China, meanwhile, remains deeply involved. Although Chinese lending to Africa has slowed, its companies are busier than ever. Guinea has finally begun developing Simandou, one of the largest untapped iron ore projects in the world, backed by Chinese firms and Rio Tinto. In the past 2 years, Chinese companies have also purchased a rare earth project in Tanzania, a copper mine in Botswana, and gold mines in Congo, Ghana, and Ivory Coast. One of Africa's biggest economic constraints was not tariffs or trade policy, but geography. African countries often traded more with Europe, China, or the United States than with each other. Transporting goods across the continent could be slower and more expensive than shipping them overseas. Border delays, poor roads, fragmented rail networks, and incompatible regulations made regional trade difficult. Intra-African trade has historically accounted for less than 15% of the continent's total commerce, far below the levels seen in Europe or Asia. To address this, African governments have launched one of the most ambitious economic integration projects in modern history. In 2021, the African Continental Free Trade Area, or AfCFTA, officially began trading. The agreement aims to create a single market of 1.3 billion people with a combined economic output of more than $3 trillion. If fully implemented, it would become the largest free trade area in the world by number of participating countries. The goal is simple: make it easier for African countries to trade with each other. Infrastructure investment is a crucial part of that strategy. From 2025 to 2029, more railways will be built in Africa than in the previous 10 years. One example is the Lobito Corridor, a rail and logistics network connecting the copper belts of Zambia and the Democratic Republic of Congo to the Atlantic port of Lobito in Angola. In West Africa, construction has begun on the Abidjan-Lagos Highway, a 1,000-kilometer corridor linking 5 major economies and serving a region responsible for roughly 3/4 of West Africa's economic activity. If AfCFTA is successful, the combination of trade integration and infrastructure development could fundamentally reshape Africa's economic geography. Yet Africa's most important economic asset may not be its minerals or infrastructure. It is its people. The continent has the youngest population in the world. The median age in Africa is just under 20, compared with around 39 in the United States and more than 44 in Europe. Over the next 2 decades, Africa's working-age population is expected to expand dramatically. By 2035, the continent could add roughly 450 million people to the global workforce, more than the entire labor force of the European Union today. At a time when many advanced economies are aging rapidly, this demographic shift could reshape the global labor market. Japan's working-age population has been shrinking for decades. Europe faces similar pressures. Even China, long known for its enormous labor force, is now experiencing a steady decline in its population of working-age adults. Each year, millions of young Africans are entering the labor market. If these workers can be productively employed, the result could be what economists call a demographic dividend, a period in which a large and growing workforce drives economic expansion, rising incomes, and increased investment. But this demographic surge also presents a challenge. Creating enough productive jobs for such a rapidly growing population will require sustained economic growth, continued investment, and significant improvements in education and infrastructure. If those conditions are met, Africa's youthful workforce could become one of the most powerful drivers of global economic growth in the coming decades. None of this means Africa's economic future is guaranteed. The continent still faces serious structural challenges, but they do mean that progress will likely be uneven. Some countries will advance rapidly, while others may continue to face instability and stagnation. In that sense, there is no single African story, only many different ones unfolding at the same time.